In this example problem, we're going to be Luscious Landscaping. We're a landscaping company that is going to attempt to make its financial statements so we can share our financial information with people that want to know something about our company. During the period, we've had a whole bunch of transactions. We've brought in cash, we've sent out cash, we've put receivables on the books, we've collected on receivables, we bought supplies, we prepaid for rent, etc. Like all of these things would have been the result of transactions that had happened during the period. Let's pretend that some other accountant on our staff took care of that, and they recorded all of those transactions in the journal as those events happened, and then they transferred those balances to the T accounts and found the balance and balance of all of our T accounts, and did the first step that every company has to do when they're making financial statements, is to make sure that you have debit credit equality after you've recorded all your period entries, your stuff that happened and you need to be recorded in your journal during the period. And for Luscious, it's true. They have $55,125 of debits and $55,125 of credits. Now, before we can make our financial statements, we have to get GAAP compliant. And that means that we have to make sure, via the accrual method of accounting, that all revenues that happened during the period and all expenses that we incurred during the period end up on the books in the same period that they were either earned or incurred. So we're doing January's worksheet right here. We need to make adjustments at the end of January to make sure that we have all the revenues and expenses that we incurred during January on January's books, which is why we got to record, switching tabs here, adjusting entries. So we have a list of adjusting entries that we have to record here. I'll start with the very first one. If you have assets that are long held that you're going to use for years and years and years, you can't expense them at the time that you buy them. You need to record a little bit of loss in value every single period, and they call that depreciation. So actually, I'm going to start right there. We're going to make an adjustment to put our depreciation expense on the books for the month of January. We have two different type of long held assets that we use in business that's going to lose value over time. For us, for Luscious, we have equipment that has a historical cost of $3,600, so that's what we paid for originally. A residual value of $0. We expect to get $0 out of this when its life ends, and speaking of its life, we think that we're going to be able to use this equipment for 3 years before we have to retire it. When we acquire an asset like this and we buy it, whatever we pay for it is its historical cost, and the other two, the residual value and the useful life, there's no hard rule to them. They're just estimates. So that's our estimate. That's our estimate of what this equipment is going to be worth at the end of its life and how long it's going to be useful for. Our other depreciable asset is a truck. We paid $26,000 for it originally, so that's its historical cost. We think that at the end of this truck's life, we're going to be able to sell it or scrap it or trade it in or whatever for $2,000. That's residual value we get back when we're no longer using this. And our estimate is we're going to use this truck for a period of 8 years. Well, we need to create a separate account to record the value that these assets have lost during the period. And that account is called accumulated depreciation. And we're going to make subsidiary accounts for the two types of assets that we are depreciating. So I'm going to have accumulated depreciation, abbreviated to ACDEP, equipment, and accumulated depreciation on our truck, increasing these contra asset accounts. We got to figure out how much value these things need to lose every period that we have them. And we're going to depreciate them, record the loss of value in a straight line, so an equal amount each and every period. And the formula that we're going to use for straight line depreciation is always the same. It is your historical cost minus your residual, or sometimes called salvage value, times 1 over the useful life of the assets in terms of years. And since we're making an adjustment for just the month of January, we're going to take the number of months that we are depreciating over 12. So what is it going to be for our equipment? Well, let's input the numbers that we're given. The equipment had a historical cost of $3,600. It has a residual value of 0. Therefore, it's going to lose all $3,600 in value over its life. Its life is 3 years, so I'm going to multiply that by 1/3. Essentially, we're saying we're going to take away 1/3 of that $3,600 of lost value every year that we use this. Since it's a monthly adjustment, I'm going to multiply that by 1/12. And when I input all of that, I come up with $100. This equipment is losing $100 in value during the period. Let's do the same thing for the truck. The truck has a historical cost of $26,000. We think it has a residual value, or scrap value if you will, of $2,000, so it needs to lose $24,000 worth of value over its life. This truck we expect to use for 8 years, so we're going to take away 1/8 of that $24,000 in lost value every year while we use it. Since this is monthly, we're going to multiply that by 1/12. And that comes out to $250. So our equipment has lost $100 in value, our truck is losing $250 in value, and all in all, to make sure that we have all of our expense that was incurred during the period on the books in the period that it incurred, we're going to record a depreciation expense of $350. Our long-held assets lost $350 worth of value in total while we used them during the month of January, and that's what we're going to record in our January 31st adjusting entry. And here we adjusted for asset depreciation. The next adjusting entry we're also going to make on January 31st, because you always make adjustments at the end of the period. So if we're making a monthly set of financial statements, it'll be on the last day of the month. This adjustment is for supplies that we actually used during the period. So we buy supplies and we put them on the books. And we're going to use those supplies as the month goes on, but we're not going to remove an expense, an individual supply, each individual set of staples or pack of paper or whatever as it gets used. We're just going to do this once at the end of the period to figure out how much we used in supplies during, in this case, the month of January. And how you find that is you take the book value of supplies and you subtract out what you have on hand at the end of the period. So you go and you count supplies that you have remaining and find the difference between what your books say that you had at one point and what you have left at the end of the period. Well, right here, our physical count has revealed that we have $800 worth of supplies on hand. What do our books say we should have for supplies? Well, you can find that if you wanted to in the T accounts. Go to the T's, find your supplies T account, it'll tell you what you're supposed to have for supplies. But where do T account values get transferred to where you can find everything in one convenient place? The answer to that is the adjusted trial balance. And according to our adjusted trial balance, we have $1,000 worth of supplies. So at one point in time, we had $1,000 worth of supplies on hand that we were using for whatever we do to use them to landscape, to provide service. We had $1,000, but at period's end, we've only got $800 left. So how much did we use? Well, the amount of supplies got expended. Well, we had $1,000. We only have $800 left. We must have used the difference of $200. And I got to make sure I have the expense on the period for those supplies used in the month that they were used. So my debit is going to be to supplies expense. And I need to reduce the balance of supplies because we use some of them. Assets go down on the credit side, so let's credit supplies in that entry when we adjusted for supplies used. Next adjusting entry, also occurring on January 31st. So we are going to adjust to account for 1 month of revenues that have been accrued on a contract that we signed with Paradise Square Park. We signed this contract on January 1st, and under the terms of this contract, we're going to provide landscaping services to the park for a 6-month period. Under our agreements with Paradise Square Park, we are going to receive, and here's the important part, the full contract amount of $6,000 at the end of the contract's life, which means we're going to do work for 6 months. We signed it in January, so January through June, we're going to keep doing work on this, and when we finish the terms of our contract at the end of those 6 months, we get the $6,000 in one big blast payment. Well, we did some of this during January, which means we've earned some of these revenues, and revenues need to go on the books in the same period that you actually earn them. So my credit is going to be to service revenue. What is my debit in this case? Well, they're not paying us till the end of the contract's life, the end of those 6 months, but now they officially owe it to us. Even if they ended this contract early with us, we would still be going to Paradise Square Park and saying, hey, we did a whole bunch of landscaping work for you. you owe us at least, you don't owe us the full $6,000, but you owe us something because we met a bunch of obligations of the contract that we signed to you. And since they owe us stuff, we're going to receive payments in the future. We're entitled to it. So the debit is accounts receivable. And that is going to be for the portion of the contract that we've actually earned the revenues on. Let's recognize this kind of in a straight line as well. It's the easiest way to do it. Take your contract amount and multiply it by the number of months that you've earned over the number of months in the contract. And do a little math right here. We'll go right here and say this is going to be equal to the contract amount, which is stated in the problem is 6,000 times the number of months that we earned. Well, we signed it on January 1st. It's now January 31st, so we did 1 month's worth of work on this 6-month contract. So 1/6 of the time that we are obligated to provide service for has passed. We get to recognize 1/6 of those $6,000 in revenues we're eventually going to get, which for now is $1,000. So that is our debit to accounts receivable and our credit to service revenue. And here we adjusted for accrued revenues earned. In the next adjusting entry, we have an incredibly similar situation. So we're going to make another adjustment on January 31st. This is also for revenues earned on a contract, but we have one difference. This one is with Green Hills Apartment. We also signed this contract on January 1st, and under the terms of this contract, we're going to provide landscaping services to this apartment building for a 3-month period. The difference being here that instead of getting payment of the full contract amount at the end of the contract's life, we're getting payment of the full contract amount in advance on day 1. Well, we're still earning revenue, so we still need a credit to service revenue. Anytime you perform obligations on a contract and you make an adjustment for it, you're going to have a credit to service revenue. But our debit is different now. What we have done in the first place when we put this on the books, well, at the time that we got $4,500 in payment in advance from Green Hills Apartment and had not done anything for them yet, we had to have something to help us balance out our journal entry when we put that cash on the books, and that something would have been unearned revenue. Well, now, not all of that revenue is unearned. We've earned some of that revenue. So I need to reduce Luscious Landscaping's unearned revenue account by the amount that we actually earned. And we can use the same math that we had up here. This contract has a contract amount of $4,500. Signed it on January 1st. We've been working on it all month. It's now January 31st, so we've met 1 month of the obligation out of the 3 months that the contract is for. We earned 1/3 of the revenues, and 1/3 of $4,500 is $1,500. In this case, we adjusted for deferred with no 4 in it. There we go. Revenues earned. So, difference between accrued and deferred. Accrued means service first, cash later. Deferred means cash first, service later, which is exactly what's happening here. The accrued revenues are coming from a thing where we're providing the service before we get money at the end of the life, while the deferred revenues are being recorded for something where we got the full contract amount in advance and we're providing the services later. Couple more adjusting entries left. The next one is happening also on January 31st. We're making another adjusting entry. This time we need to adjust our books for the expiration of an asset that we prepaid for in advance. So originally we went to our landlord and said, hey, how about you give us a discount on our rent if we agree to pay a whole bunch of periods in advance? And our landlord said, yes. Give me $1,800 for rent and it'll cover you for the periods of January through March. Well, now January has passed, which means some of that rent that we had helped us earn revenues, and since we record expenses in the same period that they help us generate revenues, we need a debit to rent expense. What else has to change on our books? Well, we had 3 months prepaid for, January through March. January is over with now. We only have 2 months remaining on here, which means we need to reduce the balance of our prepayment. So our credit is going to be to prepaid rent. And we'll use the same formula that you always use for the adjustment for the expiration of prepaid assets. It is the original prepayments, total amount that you paid, times the number of months adjusted for over the number of months that you originally prepaid for. So for us right here, we originally prepaid $1,800. We are adjusting for 1 month's worth of expiration, just the month of January, out of the January through March, 3 months that we prepaid for. So 1/3 of our rent coverage, if you will, is expiring. And we now get to expense 1/3 of that prepayment, which is $600. So that's going to be our debit to rent expense and our credit to prepaid rent. And here we adjusted for rent expiration. Next up, on January 31st, we need to adjust our books to make sure that all of the salaries that we paid our employees during the period, all of the salaries that our employees earned during the period are on the books in the same period that they earned them, even if we've not paid them yet. So for Luscious Landscaping over here, we have salaries that were earned by our employees during January. We've not yet paid them. So January must end in the middle of the pay period. They work days in January that they've earned the money for, but they're not going to get paid for those until sometime in the beginning of February. We know that our employees typically get paid $1,200 on salary for every 10-day bi-weekly period that this employee works. Well, they've worked 3 days during January before the month ended that they've earned those wages for. Even if they never came into work on February 1st, they would still have earned those. We'd still have to pay them. But we're not actually paying them until February. But those 3 days that they earned during the month have to go on January's books. So we need to record a salaries expense for the amount of money that they've actually earned during the period. Expense accounts increase on the debit side, so we're going to have a debit to salaries expense to increase the tracking of how much we incurred in salary costs during this month of January. But since we're not actually paying them until the subsequent period, we can't credit cash. What we got to do is put a liability on the books saying we owe our employees. And liabilities go up on the credit side, so our credit is to salaries payable. And the formula to figure out how much you need to put on is the portion of their normal pay that they've actually earned. So we'll take the pay in a normal period, and we'll multiply that by the number of days that they've earned over the number of days in a normal pay period. So our salaries expense is going to be equal to the portion of the $1,200, the pay that they have in a normal period that they've earned. Well, how many days has this employee worked since that they've earned during the period? They've worked 3 days during January. They've not yet been paid. But their normal pay period, that $1,200, is normally for a 10-day bi-weekly work period. So if they worked 3 out of the 10 days for which they're going to be paid coming up already, we got to recognize 3/10 of their next paycheck as a salary expense during this period. And 1,200 times 3/10 is $360. And this is another instance where we're recording the expense before cash is going to change hands. So we adjusted for accrued salaries owed. And then our last adjustment in this example, on January 31st, we're going to adjust our books for 1 month worth of interest being accrued on our outstanding notes payable to Catskill Bank. So we took out a loan from a bank. We got cash when we took out the loan, and we got to repay them in the future. But now we don't have to just repay them the $12,000 that we borrowed, because they're going to constantly be ticking up interest on this loan. So interest that is earned on the loan that we're going to obligated now to pay to our lender, to Catskill Bank, has to go on the books in the period the interest was actually, as they say, accrued on the note. So we'll use the standard formula for any interest, which is principal times rate times time. What do we know here? Let's start with the numbers. We know that the principal balance currently of this note is $12,000. We know that the stated rate that we agreed to when we signed our promissory note to take out this loan is 4%, but they always have that as annual percentage rate. So now by time means what portion of a year are we accruing for? We're accruing for 1 month. So 1 out of 12. And when I math all that out, I come up with $40. So at this point in time, we wouldn't just have to repay this bank the $12,000 that we had. We have to repay them $12,040 for the principal balance we owe, plus the amount of interest that is accumulated on this note. That interest accumulated during January, so we're going to record the interest expense during the same month. But since we're not going to pay on this until we actually pay off the note, the credit's not going to be the cash, it's going to be the fact that we owe the bank interest, which is a liability because we owe somebody something. That's interest payable. So for each and every adjustment that we have in here, we have an expense or a revenue account involved in the entry. Just scrolling up through, every single one of them has either expense or, for the two contracts, revenue recognized. And that's the purpose of adjustments, to make sure that all expenses and revenues that were earned or incurred during the period end up on the books in the same period. So we can wrap up recording our adjusted entries right here now to finalize this entry where we adjusted for accrued interest on note.